Hi traders, Nathan Bray here from ACY Securities. Now I want to do a bit of a trade review. Last week we were looking at shorting opportunities in line with the longer term trend on both the Aussie against the USD and the New Zealand against the US dollar. Why? We had a very strong US dollar over time, but the real complexity was we were doing it at a time where both the Aussie and the New Zealand Reserve Banks were beginning to raise rates to fight inflation. Now, one might say, but if you're raising rates, isn't that positive for a currency? Now, what we saw was an initial spike up, as we were suggesting could happen. At that point, we were looking to take advantage of an immediate rise in the Aussie against the USD and also New Zealand against the USD. Now, we've now seen price move up, looking to take advantage of the trend in line with the longer term trend and short it. Now let's have a look and see how that trade idea has performed. And you can see the technical setups were pretty much spot on. We did get that initial move up on both the Aussie and the New Zealand, and since then we've seen a dramatic fall. The Aussie all the way down from that 65 level. In a matter of a week or so, we've seen it move to about 62.50. So a huge sell-off. Now the question I've been getting is, well, shouldn't it be positive for a currency if they're raising rates? Now, one of the things to think about is this. We have an extremely strong US dollar at the moment. Now, if you look at the 10-year yield, we've gone from, at the start of this year on the US dollar in the bond market, 1.25 to 1.5% is what you would get return on your money if you bought a US bond. Now we've moved, this year alone, all the way up to just touching 4%. So it's almost a guarantee. You can put your money into US dollars, buy a bond, go from getting a return of 1.25 all the way up to 4%. So the market is looking at that and saying, well, gee, that's a really safe return. So we're seeing a lot of money going into the US dollar. Now, as a result, we're seeing pressure put on countries with fundamental weakness, like the Australian dollar or the Australian currency, and of course we've seen it happen with the New Zealand currency as well. Now, the other thing to keep in mind is what is the difference or the carry trade in their interest rate. So when you think about Australia only offering 2.6% in a fundamentally weak currency, versus a very strong US dollar currency where you can get, up to 3.5% on US dollars. So you got this 3.5% in a strong currency versus a fundamentally weak currency like Australia, where they're only going to offer you 2.6%. You throw in inflation problems on top of that, and we can start to get a really solid idea of how this trade has worked on both the Aussie short and the New Zealand short over the last few weeks. Happy trading, everybody.